So what do I mean by normalized? Well, imagine so price is not normalized, right? You've
Hmm.
got some stocks that trade below $5, even below a dollar. You've got some stocks that trade over $1,000 or even higher. If you use price as a column there, that's not going to normalize very well. Like imagine, another one like change from the close. If you use that in a decimal format, not a percent, it's not going to generalize very well. It's not normalized across the entire market. So when you try to use a filter like that, you're going to have these what I call like cliffs in the data where
Hmm.
it just, a 50-cent move in a really expensive stock is like nothing. That's basically a tick, but in a smaller price stock, that's enormous. So that's what I mean by find columns where they're normalized and a similar value is sort of generalized across a whole, basically the entire market.
Hmm. Yeah, and I think it's very easy to describe with just standard examples of, people say, "Oh, I get this question all the time about like trailing stops. What kind of trailing stop should I use? Should it be like 20 cents or something like that?" And I'm like, "Okay, well, 20 cents on a $1 stock is a massive trailing stop. 20 cents on Tesla or right MicroStrategy or something like this is going to be almost the spread and you're going to get clicked out instantly." So, yeah, you should take whatever it is and think about not comparing it to any sort of broad averages, but back to the stock itself, right? So that's how I always look at it when we're talking about standardization is everything you do has to be related to some other way of on how the stock moves, why I think ATR is such a good example because you're just saying how much does the stock normally move for whatever bar length you're looking at daily, weekly, or 1 minute, and just let's compare that and then compare that back to what's happening now.